The S&P 500 just closed at 7,499.36, up 0.79%.
Barely missed that 7,500 mark.
Right. And the Nasdaq surged 1.52% to 26,213.72, while the Dow printed a record closing print at 52,319.2 bim.
Yeah, quite the scoreboard.
The mid-year buzzer just sounded. It is the evening of Tuesday, June 30, 2026. The closing bell rang 15 minutes ago on the second quarter, and we have a stack of institutional market notes breaking down exactly what just happened. Our mission today for this deep dive is to separate those flashy headline numbers from the actual mechanics of where the money is flowing, because Q2 looks like a massive victory lap.
It looks like it, yeah.
Yeah.
But buying into that headline green right now, I mean, without looking under the hood, is incredibly dangerous.
Dangerously misleading.
Exactly. If you examine the underlying mechanics of what just happened into the close, the narrative of why this market moved is pure smoke and mirrors. Today was the definition of a head fake.
A head fake. But
yeah, this was not a breakout. It wasn't organic conviction where everyone's universally bullish. It was highly concentrated, technically driven liquidity just to dress up the quarter-end books.
okay, I want to push back on that right out of the gate, because a nearly 15% quarterly gain for the S&P, I mean, that's real money sitting in retirement accounts.
Sure, the gains are real.
Right. The Dow is above 52,000. So if the major indices are shattering records, why should you, as the listener, care whether it was human conviction or, just a bunch of trading algorithms doing the buying today?
You care because of structural fragility.
Okay, explain that.
Well, when a market moves on organic conviction, you have broad participation, right? People are buying across the board, industrials, healthcare, materials.
Right, because they believe the whole economy is growing.
Exactly. That creates a stable foundation.
Yeah.
But what we saw today was the exact opposite. Institutional desks call this the breadth illusion.
The breadth illusion. So let's unpack those internals.
Yeah, so you have the major cap-weighted indices painting this picture of effortless strength. The MEG-IS ETF, holding the mega-cap tech giants, it gained for a third consecutive day. But market breadth, specifically the advanced decline ratio, it was actually negative on the day.
Which means more individual stocks fell today than rose.
Right. It's the ultimate red flag. The small-cap Russell 2000 severely lagged, closing at 3,024.37. It barely crawled up 0.5%. The troops are simply not following the generals here.
It's like a sports team winning a championship game, but when you look at the stats, one superstar scored 95% of the points while the rest of the team was actually, losing ground.
That's a great way to look at it.
So how do we get a record index close when most of the market is in the red? Walk us through the actual mechanism.
It's quarter-end window dressing combined with massive forced passive rebalancing.
Okay.
At the end of every quarter, institutional fund managers, they have to report their holdings to their clients. Now, tech has been this massive high-flying winner for the last 3 months, right?
Right, obviously.
So a portfolio manager wants to make sure their fund is heavily stacked with those exact tech names when the snapshot is taken on June 30th. It just makes them look smart.
So they're essentially sweeping their losing trades under the rug and frantically buying the shiny trophies right before the photographer takes the picture.
Precisely. We have the volume confirmation right on the tape. Into the close, in those final minutes of trading, we saw institutional volume bursts hit over 63.1 million shares.
Wow.
Yeah. That translates to $12.7 billion in transactions just aggressively pushed into mega-cap tech.
But wait, looking at the derivatives data, this is where the narrative of a massive organic rally kind of completely falls apart for me.
Yeah, the options data is telling.
Right, because overall S&P 500 options volume was only around 4.63 million contracts today. That's, less than 89% of the 30-day average?
Yep, it was dead quiet.
So if the smart money is supposedly throwing $12.7 billion into the market at the close, why is the options market so incredibly quiet? Doesn't that mean everyday retail investors and active traders were basically setting this one out?
They were. Real money sat on the sidelines today. The options market is typically your playground for active speculation, human hedging, seeing massive volume in the underlying stocks, but crickets in options. It proves this was not organic fear of missing out.
It was forced, mechanical.
Completely mechanical. Going into the close, we saw nearly $1.9 billion of net positive institutional buy imbalances. It was heavily skewed toward tech.
And that afternoon buy flow wasn't humans chasing a rally. It was price-insensitive passive funds reweighting.
So for the listener, the takeaway here is that this isn't a healthy, broad-based bull market you just blindly buy into. It's a fragile foundation.
Very fragile.
But let's look at the timing. If everybody knows that institutions have to window dress at the end of June, why wait until the absolute final hours to dump $12.7 billion into megacaps? I mean, that seems incredibly risky.
Yeah.
It is a massive risk. Unless, of course, you are handed the perfect macroeconomic cover to execute those trades. And today, the global geopolitical fear premium that's been kind of hanging over the market, it just evaporated.
Right, so this is where we pivot from domestic trading algorithms to global shipping lanes.
Exactly.
Because to understand why billions flowed into tech today, we actually have to look overseas. Over the past month, the biggest overhang has been the Middle East.
Specifically, the threat to the Strait of Hormuz. It's a critical choke point for global energy. If conflict disrupts that shipping lane, oil prices spike.
And if oil spikes, inflation rebounds.
Right. And if inflation rebounds, the Fed abandons any idea of cutting rates.
Which would crush tech stocks because their valuations rely heavily on the promise of cheaper borrowing costs.
Exactly. But that entire nightmare chain reaction was dismantled today. U.S. and Iranian negotiators arrived in Doha to formalize a truce. The immediate threat to the shipping lanes dissipated, and the market repriced that risk in minutes.
And we saw that instantly in the energy sector, right? It was the absolute laggard of the day. Brent crude slid 1.3% down to 72.95 a barrel. WTI crude fell to 70.0.
Yeah, the narrative completely flipped from an imminent supply shock back to a looming global glut.
But how does that directly trigger the tech rally?
Well, a drop in energy prices immediately eases the pressure on treasury yields. When you remove the threat of an energy shock, you cool down the market's fears of a hawkish Fed, and that directly impacts volatility. The VIX was completely crushed today.
Plunging, what, 7.08%?
Yeah, down to 16.40.
I want to pause and really drill down on this because it's crucial. Are we confusing a temporary lack of geopolitical panic with actual sustainable economic strength? I mean, did dropping oil prices just give managers a convenient excuse to buy the dip?
That's exactly what happened. You have to look at volatility control funds, these systematic trading algorithms. They don't read geopolitical news in Doha. They only read the VIX. They operate on strict math. If the VIX drops to a multi-day low, their models view the market as safe. They're structurally forced to increase leverage and buy equities.
So they had $12.7 billion of window dressing to do, and the collapsing VIX just gave them a wide-open runway.
Zero hesitation. They bought the close because the macro backdrop gave them the structural cover to do it.
Wow. Okay, so we know why the money moved, and we know it was forced. But looking at where that net positive flow actually landed and where the selling was ruthless, that gives us the playbook for tomorrow.
Oh, absolutely.
We saw some violent reversals today. A key reversal to look at is SpaceX, ticker SPCX.
Yes, SpaceX is the textbook example today of passive flows completely overriding organic price action.
Right, because it opened weak. It dropped 1.74% in the pre-market.
Standard profit taking. But by the closing bell, it had reversed violently to close up 4.06%.
And that had nothing to do with their actual rockets. It was because they're being added to the Nasdaq 100 index on July 7th.
Right. Index inclusion. Every passive fund tracking the Nasdaq 100 is suddenly required to own it. They estimate roughly $4.3 billion in forced inflows for SpaceX.
But those funds usually wait until the effective date, next week.
Exactly. What we saw today was active institutional managers front-running that event. They know billions in blind buying is coming, so the early morning weakness didn't matter. The structural plumbing dictated SpaceX had to go higher.
So the smart money is just paddling out early to catch the liquidity waves.
Exactly.
But we also saw this mega rally in semiconductors. The Philadelphia Semiconductor Index was up 3.92%. AMD surged 7.68% to a record 580.91.
Yeah, that move felt more tied to fundamentals, combining with systematic buying. AMD issued really strong guidance on their 2-nanometer Venice server CPUs. Institutions were aggressively positioning for the next AI infrastructure build-out.
But here's where the tape tells a fascinating story of rotation. Because while the new infrastructure space and AI is getting bought up, legacy infrastructure is getting violently punished.
Oh, AT&T?
Yes, AT&T, ticker T. It suffered incredible institutional whiplash today. It collapsed over 5% down to 20.79. And the fundamental news is so intertwined with the tape here. Oppenheimer downgraded them today, specifically citing the competitive threat from Starlink's direct-to-cell technology.
Which is owned by SpaceX.
Right. There is a brutal poetry to that tape. SpaceX is soaring on passive inflows, and AT&T is getting crushed because of SpaceX's technology. It's like watching the old guard castle being dismantled brick by brick to build the new satellite fortress.
It really is. And AT&T's fundamental pain was compounded by a structural reality. While SpaceX benefited from Nasdaq inclusion, AT&T was officially excluded from the Russell Top 50 index today.
Oh, wow. Which triggers the exact opposite reaction.
Yeah, it triggered a massive 8 million share institutional sell imbalance. Any fund tracking that index had to dump AT&T today. Institutions were surgically buying the future of infrastructure and systematically liquidating legacy tech.
That is fascinating. Okay, so the $30 billion quarter-end pension rebalancing is now cleared from the books.
It's done.
Q2 is officially over. As we look at the playbook for Wednesday, the opening bell for Q3, these institutional desks have laid out some very specific technical levels for us to watch. The absolute line in the sand for the S&P 500 is the gamma flip level, sitting exactly at 7,467.
Right, 7,467 is critical because the S&P closed at 7,499 today. Holding that 7,467 level keeps the overall market in a positive gamma regime.
So for the listener, let's demystify that jargon. Think of that 7,467 gamma wall like an invisible electric fence.
Okay, I like that.
As long as we stay inside the fence above 7,467, the market makers are friendly. They buy the dips, sell the rallies to hedge their options books, and they keep the peace.
It forces the path of least resistance to be a steady, low volatility grind. But if we break below the delta flip level, which is sitting at 7,430 right now, the fence breaks.
The fence breaks, the guard dogs are let loose, and volatility spikes.
Exactly. Market makers are suddenly forced to sell into weakness to hedge, and the market can enter a rapid freefall.
So knowing where those trap doors are, what are the odds we get a third explosive trend day tomorrow to kick off Q3?
The chance of a third explosive trend day is under 25%.
That low.
Yeah. The market moves like a pendulum. With that massive pension rebalancing pressure gone, expect the violent expansion phase we saw today to pivot into a choppy, range-bound consolidation phase.
So the high probability playbook is do not chase breakouts at the opening bell tomorrow.
Do not chase the open, period. You want to fade the extremes and trade the intraday boundaries.
But if you are hunting individual momentum, there are a few high beta day two setups the desks are tracking. Prime continuation plays. Number one on that list is AMD.
Right. It's hunting a $1 trillion market cap. But again, don't buy the morning gap up. The smart money play is waiting for a pullback to the volume-weighted average price, the VWAP, for a retest.
We also saw a massive breakout in biotech. Abivax, ticker ABVX, exploded 37.82% today to 132.51.
A textbook momentum squeeze. Caught short sellers completely off guard. For a day two play there, let the first 15 minutes establish the range.
And we also have defense sector breakout, AeroVironment, AVAV up 23.60%. But as we wrap this up, we have to ground all these technicals in tomorrow's macro reality.
We do, because the artificially low VIX we saw today is highly vulnerable. We have ADP payrolls and the ISM Manufacturing PMI dropping tomorrow.
And the June jobs report looming on Thursday.
Exactly. If the labor data comes in unexpectedly hot, the Fed's hawkish tone comes roaring back, and that low VIX will vanish overnight. Keep a hand on the defensive levers.
So to recap, Q2 ended with record highs, fueled by evaporated geopolitical fears and a crushed VIX, allowing algorithms to heavily window dress tech. But the breadth is negative, relying entirely on a few megacaps holding that 7,467 gamma wall.
That's the reality under the hood.
Which leaves you with this final lingering thought to ponder as we head into Q3. We saw today that large cap value actually outperformed growth by 9% in June, right up until this final day of forced tech buying reversed it. If tomorrow's labor data brings the hawkish Fed back and this handful of megacaps finally loses its footing, with the broader market's negative advanced decline ratio, is there actually any structural safety net left inside that electric fence to catch the fall?